Hello, everyone, and welcome back to the Deep Dive. I hope you are fueled up and ready, because today we are strapping in for what might be one of the most intellectually complex, high-stakes deep dives we have ever done on a single equity. We are looking at a stock that, by the raw numbers, just appears to be one of the cheapest assets on the face of the earth. I am genuinely excited about the rabbit hole we are about to jump down for you today.
It's a true study in extremes, isn't it? We're looking at a company that is, fundamentally a deep value anomaly. It's a machine generating cash at an astonishing rate. But that machine is wrapped tightly in a political time bomb. This analysis requires us to wear two hats, really. You have to be the meticulous accountant, but also the geopolitical risk analyst.
Exactly. Today we are focusing laser-like on Parex Resources, Inc., ticker PXT.TO. This is a small-cap, pure-play exploration and production, or E&P company. And crucially, it operates exclusively in one single high-risk jurisdiction, Colombia.
And the immediate quantitative snapshot is what it grabs every value investor's attention. The stock is currently trading right around CAD $18.30 per share. And that gives it a profoundly discounted valuation. When we talk about discounted, we mean metrics that are truly historic. A company that is trading at roughly 2.5 times its enterprise value to EBITDA.
I have to interject here because that number, 2.5 times EV to EBITDA, it's absurdly low.
Yeah.
I mean, to provide some context for you, most healthy, growing, investment-grade E&P peers,
Right.
the ones operating in stable jurisdictions like North America or the North Sea, they often trade in the range of, 6 to 8 times EV to EBITDA.
At least.
Right, so Parex is trading at roughly one-third of the global average. That difference is the core tension we have to resolve today.
And that leads directly to the central, burning question that frames this entire deep dive for you. How is it even possible that a company generating massive, truly massive free cash flow, we're talking an incredible 11.6% projected free cash flow yield for 2025, and running one of the most aggressive share buyback programs we've seen in years, how is it trading at what can only be described as liquidation multiples? It defies conventional financial gravity.
The market narrative here is so telling. It's pricing Parex as if those current cash flows, these huge profits, will simply stop, like a total cessation within the next 3 to 5 years.
Yeah.
It's anticipating the terminal value is essentially zero.
So we have to determine this. Is this a genuine Uber Cannibal opportunity? A compounding machine hiding in plain sight, just waiting for the market to realize its brilliance once the political winds shift? Or is that low valuation a perfectly rational, justified discount being applied to an inevitable external force? The exogenous geopolitical shock. That dichotomy, that political wager versus the financial reality, is what we are here to dissect and hand to you today. That's a huge, high-stakes topic.
Before we dive deep into the fundamental business engine and start drilling into the numbers, a quick heads up for the audience.
Right. If you're looking to invest with institutional-grade tools and access global markets, which you absolutely need to do to access foreign equities like PXT.TO, we personally use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the deep dives we do here at the same time. We only recommend tools we actually trust and use ourselves for global asset management. And while you're there, please like, subscribe, and let us know your questions and your thoughts on this analysis in the comments. Your engagement drives our analysis and helps us reach more curious minds like yours, tackling the most complex investments on the board.
Now let's stop talking about the structure and start talking about the cash flow. Pillar number 1. The fundamental business engine and the commodity trap. We need to start by understanding exactly how this company makes its money, and maybe more importantly, how fragile that whole process really is.
Okay, so the first thing you need to understand is the structural reality of Parex's business. They are a black box in terms of unit economics, but only in the sense that their fate is decided elsewhere.
Right. It's not a black box because the business is complicated.
No, not at all. They are a pure-play E&P operator in Colombia, specifically extracting crude oil, most of which is the heavier variety found in the Llanos Basin.
And this immediately sets them apart from the integrated majors or the refiners. They are an upstream pure play. And here's the crucial reality of the commodity market. They are beholden entirely to global benchmarks.
Completely.
Their sales are tied directly to Brent-linked prices, which is the global watermark, But it's that price minus a very specific and dynamic differential that's applied to Colombian crudes.
Right, the differential. And that's not a static number, is it?
Not at all. It's often tied to local benchmarks like Vasconia or Castilla, and it reflects the specific quality, the API gravity, and critically, the transportation risk associated with getting that specific barrel of oil to market.
So the core of their business model is built on absolute necessity.
Right.
They have zero pricing power.
None.
This isn't a SaaS company that can raise prices by 10% because they've added a new feature. They cannot call up a refiner and say, hey, we feel our oil is worth 5% more today. They are a pure price taker in a vast, global, and highly competitive commodity market.
And because of that, their economic survival, their profitability, their entire ability to generate that prodigious free cash flow, it all depends entirely on maximizing their netback.
The netback. Let's break that down for a second.
The netback is the essential spread, right? It's the gap between that high-level global Brent benchmark and their specific internal costs. And we are talking about three major cost components here.
Okay.
First, you have lifting costs. That's the operational expense of just getting the oil out of the ground, usually measured in dollars per barrel. Second, transport costs, pipelining it hundreds of miles through often unstable territory to get to the ports. That's a huge one. And third, the increasingly high royalty costs levied by the Colombian government.
So if the global price of Brent drops, that's one hit. Or conversely, if any of those three internal costs jump dramatically, say a pipeline tariff increases or the government imposes a new environmental levy,
instantly,
that netback margin gets squeezed instantly and proportionally.
It's a relentless structural challenge that dictates their viability. This is why they're focused on efficiency as well. It's paramount.
And that segues perfectly into the Moat assessment. When we apply established competitive advantage frameworks to Parex, the analysis it's stark. It highlights a profound structural weakness.
It really does. Their product is oil. There are no network effects. There are zero switching costs for their product. A barrel of Colombian heavy oil is, for all intents and purposes, interchangeable with others on the market. And there is no counter-positioning advantage that sets them apart structurally from anyone else.
So, okay, if they have no structural moat, what is keeping them alive and so profitable? Their advantage, what little competitive edge they possess, relies entirely on process power.
That's the key. By industry consensus, they are an incredibly efficient, highly disciplined, and lean operator, particularly within the Llanos Basin. This is where the engineering discipline of the management team really shines.
Their operational efficiency allows them to maintain remarkably low technical break-even costs. They've stated these are as low as $30 to $35 per barrel of Brent.
And to put that in perspective for you, many shale operations in North America require prices closer to, what, $45 or $50 to be comfortably profitable?
And deep water projects are even higher.
Much higher. So that low-cost basis is what has allowed Parex to generate such substantial cash flows when Brent is trading significantly higher, as it has been for a while now.
But here's where it gets really interesting. This is where the competitive advantage starts to fray. That process power advantage is not only replicable by competent competitors,
It's just a problem in itself.
but worse, it's being actively and relentlessly eroded by external forces.
We are seeing regulatory pressure coming from the current political administration in Colombia, and it is actively increasing the cost of doing business.
Things like new taxes, higher royalty rates.
More complex permitting, new regulatory hurdles. It all acts as friction. It's narrowing that already thin operational moat. They are forced to run faster just to maintain the same operational netback they had 2 years ago.
This diminishing internal advantage leads us directly to the critical flaw, the core reason for this deep, deep discount. And to understand it, we apply the powerful inversion mental model.
Right. So if we were short this stock, what single factor, if it occurs, kills this company tomorrow?
The answer is absolutely clear. It is strictly exogenous geopolitical shock.
And let's be clear, this is not an operational risk.
No. Management can usually mitigate operational risks, like drilling a dry hole or a pump failing or an inflationary spike.
Those are manageable risks priced into any E&P business model.
This is a binary sovereign risk. The equity value either continues or vanishes.
We're talking about concrete, catastrophic examples that are unfortunately common in resource-rich but politically volatile regions.
Like what, specifically?
Well, if there were a total nationalization of E&P assets, a move that, while dramatic, has historical precedent in places like Venezuela and Ecuador.
A very real possibility.
Or, perhaps more realistically in the current Colombian climate, a permanent, successful blockade of the critical oil pipelines by social or militant groups. If that happens, the ability to lift and sell the product disappears. And in that scenario, the equity value would instantly drop to $0.
And that's it. That's the elephant in the room that explains the entire market discount. You're not buying a conventional company. You're buying a license to operate in a specific, volatile political reality. And the market is placing a very high non-zero probability, maybe 20 to 30%, on that license being revoked or permanently devalued in the near future.
That risk premium is what holds that multiple down to 2.5 times. It's a risk that you cannot insure against. You can't diversify it away through operational excellence alone.
And that's the perfect pivot point. If the market is punishing them with this profound existential risk, how is management reacting? Are they hoarding cash? Are they panicking? Or are they strategically exploiting this discount?
Which brings us to part 2, the cannibal effect.
Right. So moving beyond the structural risk, we have to look at how this highly disciplined management team is reacting, because this is where the quality of the operator truly shines through. They are executing a strategy that many CEOs, the ones fixated on empire building, simply would not dare attempt.
That's so true. In the E&P industry, Parex is absolutely seen as a disciplined, lean operator. They are culturally averse to what we call empire building.
Explain that a bit.
Well, it's the curse of so many energy firms, this compulsion to chase production growth just for the sake of size. It often leads them to hoard cash or buy unrelated low-return assets just to increase their total volume.
Their focus is fundamentally different, and this is why they resonate with investors who favor value creation over sheer size. It is entirely aligned with the outsider CEO mentality.
A relentless focus on maximizing per-share value rather than absolute corporate size.
The rule is simple, right? If they can't find a highly profitable, high return on invested capital way to reinvest cash into the ground,
They promise to give it back to the shareholder.
and they are giving it back with ferocity, which brings us to the cannibal model.
This is the dominant strategy of the company, and they are a textbook uber cannibal.
The history here is just remarkable in its commitment.
Over the last 5 years, management has reduced the total share count by approximately 35%.
I really want to focus on the math of that 35% reduction for a moment, because it explains the mechanical brilliance of this strategy. This deployment of capital is highly, highly accretive.
Incredibly so. Consider the financial reality. When Parex buys back its stock at 2.5 times EV to EBITDA, they are essentially acquiring a barrel of their own oil for pennies on the dollar compared to what they would pay for an equivalent barrel in an M&A transaction.
That's the critical insight. Buying back a share at $18 when that share is generating, hypothetically, $7 in cash flow annually.
It's an immediate and highly efficient use of capital,
You are getting an instant 38% return on that specific deployment.
which is often far, far better than the returns they can expect from a new drilling project, especially given the increasing geopolitical risk.
Every single share they retire mechanically inflates the earnings per share. It accelerates the per-share value growth, even if the actual oil production volume or top-line revenue just stagnates.
But this strategy, as powerful as it is, relies on one critical condition.
Which is what?
The stock must remain undervalued. If the multiple were suddenly to double to 5 times EV to EBITDA, the instant rate of return on that buyback drops dramatically.
The accretive nature diminishes drastically.
This dynamic almost suggests the management team is incentivized by, or at least they're exploiting, the current market discount. They see the political uncertainty as a buying opportunity for their own stock.
Now, when cash flows are this high, we have to perform a crucial check, the quality of earnings test.
Yes. Many companies, especially those boasting massive free cash flow yields, have hidden issues, things like high maintenance capex or excessive stock-based compensation that make their reported FCF less valuable or sustainable.
So as part of this test, we have to look at the recent margin trend. And operating margins have actually contracted significantly recently.
A lot.
They've dropped from historical peaks of around 65% down to approximately 25% in the latest reporting periods.
And that's due to that double whammy we discussed earlier, right?
That's exactly. Lower realized net oil prices combined with inflationary operating expenses in the region. This pressure means the E in PE is under substantial ongoing stress. Those earnings are less robust than they were 3 years ago.
But here is the gold standard reality check. especially when you compare them to trendy, high multiple sectors like tech or SaaS, and that's stock-based compensation, SBC.
The silent killer.
The silent killer of shareholder value for so many so-called growth stocks. It results in massive annual dilution, often 3 to 5% annually, which just chips away at shareholder ownership.
For Parex, the SBC impact is truly negligible. I mean, we are talking about a cash-settled recovery of just $2.6 million against hundreds of millions in operating cash flow.
So what this means, and this is fundamental for the value investor, is that their free cash flow is real distributable cash.
No funny business.
No hidden accounting adjustments or ongoing equity dilution that are inflating the FCF figure while simultaneously chipping away at your ownership stake. The money they report is the money they actually have to allocate.
This quality of cash flow, however, must be tempered by what the management does with it, the capital allocation efficiency.
And historically, Parex delivered a stellar return on invested capital, their ROIC. It was consistently above 15%. This performance comfortably exceeded their cost of capital, or WACC.
Let's clarify why their WACC is so high, though. It's estimated at 12% to 14%.
Which is substantially higher than the 8 to 10% WACC often applied to similar companies in the US or Canada.
And that differential, that extra 4 to 6%, is the mandatory political risk premium.
Exactly. It just costs more to finance a project in Colombia than it does to finance one in Texas because of sovereign instability.
So historically, by generating a 15% plus ROIC, they were creating significant value. They were operating with a strong positive spread.
But we have to wave a bright red flag regarding recent performance.
What's the flag?
Current ROIC has dipped significantly, down to approximately 7% to 8%. And when your ROIC is 7%, but your cost of capital is 12 to 14%, you have a negative spread. You are actively destroying value with every dollar you reinvest in the business at the margin.
This suggests that the efficiency of new capital deployment, the dollars they're investing in the ground today to find new reserves, is degrading. It's because of those increasing costs and political headwinds.
So if the returns on new drilling are degrading, the allocation strategy becomes even more crucial. Where exactly are they deploying the cash?
The company has a clear, disciplined deployment hierarchy that reflects their outsider CEO mentality.
Number one priority is CapEx for maintenance.
Non-negotiable.
Absolutely. This capital expenditure is necessary and must be deployed just to combat the short reserve life decline rates inherent in their fields. They must invest just to keep production flat, otherwise the entire business starts shrinking immediately.
Next, they prioritize dividends. And this is a massive, attention-grabbing 8.4% yield that demands attention.
We call this a cash handcuff, don't we?
We do, because it provides necessary yield support for investors who are waiting, sometimes very impatiently, for the equity to appreciate and the political risk to dissipate.
It pays you well to tolerate the risk.
It pays you very well.
Yeah.
But it also creates a structural dependency. If that dividend is cut, investor confidence collapses.
Third in the hierarchy are the buybacks, which we already discussed. This is the primary engine for per-share value growth, the most accretive use of capital right now because the stock is so cheap.
And finally, mergers and acquisitions, M&A. They are notoriously disciplined here, often passing on opportunities.
They avoid what Warren Buffett famously called diversification.
Meaning they won't buy some random low-return asset in a completely different country or industry just to burn cash.
So the takeaway here is that management is highly aligned, they're disciplined, they're smart, but the macro reality of the jurisdiction is making their core function-finding, high-return drilling projects increasingly impossible.
They are masters of their domain, but their domain is shrinking and becoming fundamentally riskier.
All right. If we shift our focus from management discipline to the physical reality of the business, we quickly realize that the company is not constrained by market demand.
No, you don't have to worry about the total addressable market for crude oil. It's massive.
The constraint is entirely internal and geological. It's all related to the reserve life index.
So unlike a software company that can scale infinitely, or a manufacturing company that can just build a new factory, Parex is constantly fighting against the physics of its existing oil fields.
Oil fields naturally decline over time. It's just a fact of life.
This is why we call it the growth treadmill.
The core driver for long-term survival is aggressive near-field exploration.
Drilling these big E wells, often in proximity to existing infrastructure, in specific high-potential areas like Araka or VIM-1.
And it is a constant, high-stakes endeavor.
Why is it so high stakes?
Because their reserve life is relatively short compared to industry peers, typically only a handful of years.
And E&P fields generally suffer natural decline rates of what, 10 to 15% annually?
At least. So if Parex extracts 1 million barrels this year, they must find, prove, and produce an equivalent 1 million barrels just to break even, just to stay flat.
And if they start running on that treadmill,
Production will begin to collapse quickly, rendering the entire financial model obsolete within a few short years.
this brings us back to the market's perspective, which is the most critical part of this analysis. We need to look at the market's wager and what the current valuation implies about Parex's future.
When we perform a reverse discounted cash flow analysis, asking what future performance must look like to justify the current stock price, the implied expectation the market is baking in is truly shocking.
Trading at approximately 2.5 times EBITDA and a forward PE of about 6 times for 2025. The math suggests the market is pricing this company for liquidation.
And think about what that means in practical investor terms. The market isn't anticipating a slow, managed decline. It is anticipating a total, irreversible cessation of cash flows in the near term, somewhere between 3 and 5 years from now.
The cash flow profile is so strong today that to achieve this extremely low multiple, you must assume terminal value. The value of the business beyond year 5 is 0.
And this is where the concept of the zero growth baseline check becomes highly relevant.
Right. Any company trading at a free cash flow yield consistently over 15% is fundamentally implying zero growth indefinitely.
Or perhaps even managed decline.
Therefore, any successful near-field exploration finding a successful new well or a reserve upgrade, like the promising recent result in Araka, it's effectively treated by the market as a free option that they're just refusing to price in.
The market is saying, we believe the political risk outweighs any geological success, no matter how good the geology is.
Okay, now that we have established the market's bearish wager, let's try to triangulate a genuine intrinsic value for the business, assuming the worst-case geopolitical scenario does not immediately materialize and they continue to operate for the long term.
Right, let's use 3 methods to bracket the possible fair value.
Method A, mean reversion. We look at the company's historical valuation norms. In periods of relative stability, Parex traded at significantly higher multiples.
Much higher. So if political risk were to subside even partially, we would expect a mean reversion back toward a more respectable 10 times price-to-earnings multiple, which is still a discount to peers, by the way.
And applying that to the estimated 2026 EPS of $2.60 gives us an intrinsic value target of CAD $26. This suggests immense upside over 40% if that political cloud lifts.
Method B analyst consensus. We average the targets set by major investment banks, and these targets tend to be slightly more pragmatic, more focused on the immediate one-year runway, often less focused on the extreme tail risk.
And the average of those targets sits around CAD $21.25. This offers a more pragmatic, near-term price target that reflects their operational competence without requiring a major political change.
And finally, method C, owner earnings, or zero growth perpetuity.
This is the highly conservative floor, the true deep value calculation.
We take the estimated steady-state FCF, say $1.50 per share, and we divide it by a high risk-adjusted discount rate of 9%.
At 9% reflecting the need for high returns, right?
Exactly. And this highly conservative valuation floor sits at CAD $16.50. This represents the value if the company achieves no growth whatsoever, but simply maintains stable cash flows in perpetuity without being expropriated.
So those 3 methods give us a bracket. $16.50 on the low end, $26 on the high end. We define the optimal range for safety, the buy zone.
Based on that owner earnings floor and allowing for a small margin of safety against immediate shocks, that range is typically CAD $15 to $17.
And the current price, trading around $18.30, is slightly above that deepest deep value zone. But it remains profoundly attractive relative to the potential upside of $26 if the political landscape ever stabilizes.
The margin of safety here isn't purely financial, is it?
No, it is a political margin of safety that dictates the ultimate outcome. You are fundamentally betting on the stability of the Colombian state over the next decade.
Okay, so to truly understand the risk, we have to challenge the bull case with the hardest questions. We need to discuss why the permanent Colombia discount risks are so insidious and not just temporary headwinds.
The core long-term risk isn't necessarily immediate, dramatic expropriation tomorrow morning, but rather policy strangulation.
Yes. The political reality, driven by President Petro's ban on new exploration contracts, is acting as a literal chokehold. And while the government must respect existing contracts, which allows Parex to operate today, this policy effectively strangles the company's long-term inventory replacement strategy.
That is the ultimate existential threat.
It means that as Parex drills its existing reserves and as its current production depletes,
Remember that 10 to 15% annual treadmill?
it has no ability to replenish its long-term resource base with new future fields.
This pushes the company's terminal value relentlessly towards zero within 10 years, maybe less.
It essentially puts the company on an irreversible liquidation timeline, regardless of how well managed it is today.
And furthermore, the company faces constant operational risk from the ground up that undermines the compounding power. Operational volatility driven by social blockades.
We've seen this repeatedly, haven't we? At key blocks like LLA 32, local community disruptions, often fueled by political dissatisfaction or local demands, frequently result in spontaneous and prolonged shutdowns of production.
And what does that volatility do to the financial model?
It destroys the essential compounding effect of steady, predictable cash flows.
So if management is trying to run an uber-cannibal strategy, retiring shares every month, but their cash flows stop for weeks or months at a time,
They lose that momentum. They risk breaching debt covenants.
though Parex is unlevered, which is a key defense for them.
True, but the entire buyback model becomes less efficient and more unpredictable. Volatility in cash flow is anathema to compounding returns.
Okay, now let's synthesize the core arguments, starting with the optimistic view.
The bull case summary rests on three undeniable mathematical points. First, cannibalization. Buying back 5 to 7% of the total outstanding float annually at multiples this low, 2.5 times EV to EBITDA, it mathematically forces share price appreciation even if the underlying business activity is completely flat.
You're creating value simply by shrinking the denominator.
Second, yield support. The substantial 8.4% dividend acts as a powerful incentive. It pays investors handsomely to be patient.
It's a literal cash reward for tolerating sovereign risk, providing a high floor under the equity price.
And third, inventory upside. Successful recent exploration, particularly in Iraq, holds the potential to significantly increase the company's proved and probable reserves. If they can successfully prove that inventory is significantly larger than the market currently believes, it forces a necessary re-rating of the stock multiple, perhaps moving from 2.5 times up to 4 or 5 times EV to EBITDA.
Which would unlock massive shareholder value overnight.
That sounds compelling, but let's look at the counter-argument. The bear case summary is the value trap illusion. I want you to challenge the assumption that the company is truly cheap.
The challenge is that the low PE ratio is highly misleading. It's misleading because the E, the earnings, is profoundly cyclical and highly likely to drop further. It's due to that confluence of margin compression and geopolitical instability.
So if the earnings drop by 50% next year,
That 6 times PE instantly becomes a 12 times PE, which is no longer cheap.
the second point is about the perceived infinite cost of capital. The political environment is so hostile and the sovereign risk so high that it effectively prevents meaningful multiple expansion.
What do you mean by that?
No major institutional investor, the kind of firm that could drive the stock price up to that 20-cent dollar mean reversion target and keep it there, is willing to commit meaningful capital. They simply cannot afford the career risk of holding an asset that could be nationalized.
And finally, the ultimate reserve cliff. If the 2025 drilling programs, which are essential for reserve replacement, fail to replace sufficient reserves,
The production collapse is imminent and unavoidable,
and this would immediately render that 8.4% dividend unsustainable.
triggering a crisis of confidence and likely a massive revaluation downwards, erasing all the gains from the buyback program instantly.
This is where we bring in the red team challenge. Given the incredible operational discipline and the amazing cash flow, I need you to step into the role of the ultimate skeptic here and challenge the core bullish assumption that this is a compounder you can rely on for a decade.
The challenge is simple and brutal. You are mistaking a cigar butt for a compounder. Parex is not executing a long-term growth strategy. It is executing an extremely efficient, high-yield liquidation strategy. The aggressive buybacks and the high dividends are not a sign of management confidence in future growth. They are, in fact, an admission that management has no remaining high ROIC reinvestment opportunities left in Colombia that meet their hurdle rate. They are liquidating the asset on behalf of shareholders because they cannot grow it effectively.
Wow, that synthesizes the dilemma perfectly.
Yeah.
So the buybacks are less a strategic choice for expansion and more a necessary mechanism to return capital efficiently before the political climate makes it impossible.
Precisely. The analogy holds, you are buying a melting ice cube in a sauna. Yes, the cash flows are robust today and the management is incredibly skilled at catching the drips. But the environment is actively structurally working to destroy the asset's longevity.
The political tail risk is total expropriation.
And the market is right to apply a massive non-zero probability to that outcome. The discount isn't irrational. It's a reflection of political reality and the lack of a long-term inventory replacement strategy.
So let's bring this all home for the listener with the final verdict. If you had to put scores on this highly complex situation.
The quality score lands at medium-low.
Medium-low, even with the great management.
Yes, the operational quality and management discipline are excellent, world-class even, but they are fatally undermined by the structural weakness of the anti-moat and the hazardous jurisdiction. You simply cannot separate the quality of the business from the country it operates in.
And valuation score.
Undeniably cheap. This asset is priced for disaster, suggesting the market believes the probability of loss is exceptionally high.
So our conclusion, therefore, is firm.
This is investable only for active value strategies. We're talking about investors with an unusually high tolerance for sovereign risk, the ability to monitor geopolitical developments daily, and a willingness to accept binary outcomes.
For any quality, predictable, or compounder portfolio seeking long-term stability and safety.
This is a definite pass. The risk profile is simply too high to categorize it as anything other than a political wager with high short-term cash flow potential.
A fascinating analysis. It's a rare case where the underlying financial numbers look incredible, but the context makes the investment proposition almost impossible for the average long-term investor who cannot afford that total loss scenario.
So what does this all mean for you, the listener? The ultimate lesson here isn't simply about the price of oil or the quality of the geology. It's about the math of jurisdiction and the cost of capital. When a sovereign state can arbitrarily adjust the risk applied to a high-quality asset, effectively adjusting the discount rate from a normal 12% to effectively infinite due to political fiat, the asset fundamentally becomes less a business and more a political wager on regime stability.
So what's the homework?
Your homework after this deep dive is to research the historical precedent of E&P nationalization and major resource expropriation events in South America. Think back to Petrobras in Brazil or PDVSA in Venezuela, and determine for yourself where you would realistically set that non-zero probability of total loss.
A perfect and sobering final thought to cap off a truly complex deep dive. Thank you for walking us through the numbers and the risk today.
Always a pleasure. We'll see you next time for the next deep dive.